All right. The next piece I really want to talk about is LIFO liquidation. And LIFO liquidation is it's something that's inherently tied with the idea of inventory profit. And so I do want to talk about inventory profits um, first. So inventory profits is a term used in accounting to describe the difference between assuming our cost of goods sold is calculated by one, assuming all inventory sold at most recent replacement cost at year end or at period end. So essentially, if it's calculating cost of goods sold as if every unit of inventory that I sold costs the amount it would cost to replace it today, right? What the price of that inventory is for me to purchase today doesn't matter if I, during the period, sold something that I bought a year ago. This calculation plays like, okay, that's great. You bought it a year ago, probably at a much reduced price compared to today. But this calculation is saying we're going to calculate cost of goods sold as if those things were all bought today by my company and then sold. So it's giving you a very up-to-date cost of goods sold. How much does it, I sold 100 units. How much is it going to cost me to go and purchase those 100 units today? Okay. The second is for inventory profit, calculating cost of goods sold by the company's cost flow method. So whether that be FIFO, LIFO, weighted average cost, doesn't matter. We take the difference between these two. So we take one, subtract two, and that's inventory profits. So what is key is inventory profits are entirely an artifact of accrual accounting. All we're doing, we spent if we report under LIFO, FIFO average cost, we spent money. We spent cash to buy our inventory. The amount of the cost we're recognizing is dependent on accrual accounting because we're either assuming we sold all our oldest inventory first, all of our most recent purchases first, or an average of all of the inventory costs we had, right? So cost of goods sold and inventory are very much influenced by these three items, but that does not change ultimately how much cash we had to pay in order to get the inventory. So this is a sort of calculation to see how much has the accrual accounting distorted our true cost of inventory, or the cost of inventory, if you will, that the company will have in the future. Because we're talking about the most recent replacement cost at period end. We're talking about the price I have to pay today in order to replace all the inventory I sold. Okay. So it gives me an idea of how much these methods might be distorting what we're going to see in the future. Okay. All accrual accounting, right? Now, which of these methods, these three, will produce the lowest inventory profits? Well, think about it in terms of it would be the method of these three that is most likely to grab recent price inventory costs, right? And consider those sold first. Because if we're thinking about like inventory costs on a graph, for example, this is the cost and this is over time, and say they're moving up over time, this is where my current replacement cost would be at the end of the period. Well, which one of these methods would take the costs around here and, say in this section of the graph and assume those were sold, right? Well, LIFO assumes the most recent purchases were sold first, so it tends to have the higher priced items being part of my cost of goods sold, which means LIFO has the lowest inventory profit because we'd be taking this point as number one and subtracting some value along this line that's not too far down. If we're talking FIFO, we're operating all the way over here maybe, right? And taking these older costs because FIFO assumes we sold the oldest stuff first. And so that would produce a substantial higher value of inventory profit than LIFO would. So that's inventory profits or the idea of inventory profits. Um, how it applies to LIFO liquidation is basically this calculation is used. LIFO liquidation is undesirable. That's something that we need to understand. The whole purpose of reporting under LIFO is to get those higher inventory costs and report them as a part of cost of goods sold because we want higher cost of goods sold, because we want less taxable income, because we want lower taxes. LIFO liquidation is when we sell through all purchases during the period, all purchases made in the current period. And that's important. So basically, sales, or I should say, units sold are greater than units purchased. And this is just for, the period that we're in. When this happens, I have to start going into the purchases that I made in prior periods. So basically, I'm starting to dip into my beginning inventory rather than selling recent purchases, which under LIFO tend to be higher costs up here. Instead of selling in this cost uh, bandwidth, if you will, up at the top of the graph, we're starting to sell down here at lower costs. LIFO would begin to assign these lower costs down on this portion of the graph if it's already sold through everything up here. So that's when the layers start, we call it liquidating LIFO layers. They start liquidating layers of prior sale points. And I go through all of that in the notes. Make sure you pay attention to that example and understand the idea of what's happening here. So when this happens, we assign older prices under LIFO, older inventory costs, and those older inventory costs tend to be lower prices, which implies we're going to report lower cost of goods sold, which implies we're going to have greater taxes. So this is why it's undesirable. Right? There are even like there's been an evolution of how companies record inventories simply because they don't want to liquidate LIFO layers. And it gets a little complicated. It's called dollar value LIFO, but essentially they're trying to prevent this from happening, that the units they sold will be greater than the units they purchase, and leading to lower prices assigned to cost of goods sold, higher taxes. So let's look at a problem. The first one under the first example, and it's a simple, determine the inventory profits resulting from the LIFO liquidation using a tax rate. So Ranger had the following layers of inventory in beginning inventory at the start of the year 2020. So even though it looks like, this might look like a purchase sale log from a prior, it is from the prior period, right? But we're at 2020, so we're reporting our inventory at, our ledger would report 925. But our meticulous records in-house would show us that this 925,000 is actually made up of layers of inventory that were bought in the prior year at various costs per unit, right? And of course, the inventory costs are rising over time, as I tend to make it. Um, so we start here, but we have these layers embedded in this number, different price points of inventory. So during the first quarter of 2020, Ranger purchased an additional 63,000 units at a prevailing price of $55. And that $55 also equaled the replacement cost at the end of the quarter. So remember, under the inventory profits, that's going to be an important piece to calculate. So that this is our $55 is our most current replacement cost at the end of the period. Ranger sold 80,000 units during the first quarter of 2020. So we have 80,000 units sold, which is greater than the 63,000 units purchased. This is the setup to understand there's been LIFO liquidation, because now the idea is, well, we didn't just sell through the 63,000 at $55 each. I need to get 17,000 more units. All right. Well, considering that I'm using LIFO, I need to pull that from the most recent purchases prior to this quarter, right? This quarter, they were all at 55. I have to dip into my beginning inventory. So I'll take those 2,000 at 39 per. The math is already done. It's 78,000. All of them are going. I'm just going to write the number of units here so I can keep track. My goal is to get 80. I have 65 right now. Another 4,000 gets me up to 69. That's the total value of that layer. Still need more. I need 11,000 more. I'm going to take the 3K. Those were at 99. So now I got 7,972. I need 8,000 more. And I'm going to take those from this first layer all the way back to the first of the preceding year. Um, and I said I need 8,000 more. 8,000 at 30 per unit. So that's going to give me, oops, sorry. That's going to give me 240,000. And the 63,000 and 55, I'm going to have to go to the calculator so I don't flub that. 63. Whew, that's actually going to be the bulk of our price, especially with the increase in the price, $3,465,000. Right. So now we just add up all of these. This would be my cost of goods sold if I reported using LIFO. So what we're calculating here is one of the items we need in order to record inventory profits. This is, if you're looking at the numbering scheme I laid out on the other page, this is the second one. The cost of goods sold recorded under the cost flow assumption the company is using. Now, we need to compare that to our first figure that I put on the other page, which is assuming that all of the units sold, all 80,000, were priced at the prevailing price today, the current replacement cost. So that's 80,000 times 55,000, $55 is 4,400,000. And now we have my two numbers that I want to take a difference for. I'm going to take the difference between these two. Should be a zero in there. 4,430,000, which comes to $370,000. This is pre-tax inventory profit. Remember, basically what we're doing here is finding a cost of goods sold, version one, if you will, and subtracting cost of goods sold under a second version to determine, well, how much less cost of goods sold am I going to report using this method? Well, I'm going to record $370,000 less of cost of goods sold, which is profit. Okay. Now, this is pre-tax because cost of goods sold is much further up the income statement from tax. So if we wanted to strip out the tax effect under a 20% tax, I would just take 80% of this number, which is equivalent to subtracting 20% from 370,000. And I would get an after-tax pre-tax, I'm sorry, after-tax pre-tax, an after-tax inventory profit of 296,000. Companies are required to disclose this if the amount of inventory profits are material. So this is a required disclosure. If inventory profits are material. And material just means significant. It's just an accounting or a business term that's thrown around a lot to imply significance. Given that this is over a 5% change, almost a 7%. I'm doing the math in my head. Yeah, it's even more than 7%. And since this is a 7% change to cost of goods sold, that actually is rather significant, right? 5% tends to be a rough rule of thumb for significance, depending on what you're talking about. 5% of sales, 5% of the original value, so on and so forth. So that is something that would likely be reported in the company's financials. But that's inventory profits, LIFO liquidations. The idea being we could not assign a current cost to all 80,000 units. And so we had to start dipping back into all these old price points that tend to be lower costs to assign to inventory.